Well, guys, we're going to go get started. We've learned from some feedback in our prior Wise Counsel Live discussions that we needed to give you maybe 30 to 60 seconds for your Zoom feeds to connect. So I've got with me today a partner up in Amarillo, Texas, Brandon Woodard, and Brandon's going to tell you a little bit more about himself here in a minute. But what we always like to do in these discussions is it's almost like you're sitting in our conference room and we're just kind of talking shop about different, whether it's investment topics or planning topics. And we kind of like to hit on different types of topics each week to kind of keep it fresh and keep it moving along. So this week we rolled around to the idea of discussing what we talk about in our industry, risk management. And we'll get into what that really is all about here in a second. But I thought, who better than Brandon to join us and kind of give some perspective on it, because Brandon is not only an advisor, but he's also an insurance specialist. So Brandon, before we get started, again, thank you for spending 30 minutes with us today. I appreciate it. And just take a minute and tell the folks who are watching a little bit about your background and you know how you came to do what you're doing today.
Sure, Bob. I actually grew up in a little town in New Mexico, graduated back in the late 80s from New Mexico State University with a degree in accounting and finance. And in my first life, I actually worked as a public accountant. Did that for several years, and then back in 1992 made the transition to the financial services industry. Went on with a company at that time called the Equitable, which was a major life insurance company, and they were at that time in the process of demutualizing and becoming a full financial services company. And but because of their insurance background, I had to learn to have a very strong interest in the insurance planning and developed a lot of what I know now from that time frame. I probably approach things a little bit differently because I do look at it from an accounting standpoint, a very conservative look on things. But I've been doing this since 1992. Been in partnership with Carson since 2014, and work all over the country with different advisors with their clients and their insurance needs. So.
Well, one of the things I respect about you, Brandon, I mean, there's a lot of advisors out there that know a lot about insurance and things like that. But whenever I meet people who are just as quick to tell a client what you've got is the best thing for you, you don't need anything new, as they are to say, hey, there's some issues here, you might want to think about making some changes. It really comes down to talking about integrity, right? And so I've respected the work we've done together, that I know what I'm getting from you is your honest opinion on what's best for the situation. So I've always respected that. So we've got a lot to talk about today. And just to let everybody know, when we talk about risk management, you already heard Brandon refer to insurance, and that's a big part of risk management. It's not the end all and the be all of risk management. But one of the things, sometimes, Brandon, it can be as basic as we'll use our jargon sometimes in meetings, right? And you mentioned to somebody you just met, and you say, yeah, we'll take a look at your risk management area, and they're thinking, well, what do you mean? Or they think maybe we're talking about their investment portfolio or something. So we thought that it would be good just to kind of put a frame a little bit around this idea of risk management, but particularly in three applications. And I'm going to kind of give you a chance to walk through the high level of this. If we've got enough time, we'll come back and we'll go a little deeper in a couple of the topics under the first one. So the three you're going to touch on, the areas that we see in this risk management area most commonly. One is risks that associate directly with a family, an individual or a family. The risk of dying, the risk of being too sick or too hurt to work, having extended elder care, things, that kind of stuff. That's one area that you'll touch on a little bit. Another one, though, is a lot of times people have small businesses or even larger businesses, and there's a whole nother area of risk management that insurance can, when it's needed, can be a good set of solutions. And then finally, the third category, legacy planning and estate planning. Insurance can be a big part of that in a properly crafted plan. So with that in mind, I just want to kind of kick it over to you, and let's just walk us through a high level of each of those three categories. And if we have time, we'll come back and we'll focus more on the individual side of things and family side.
Yeah, Bob, that's great. You're exactly right. And really what we focus on within our planning is and I'm going to step back 1 second with that. One other component I think is just as essential, but we don't get as involved with that on our side, is within the comprehensive insurance world of your health and auto and liability insurance stuff. So we tend to leave that to another professional segment. Like you said, we focus predominantly within our planning platforms, and what we really focus on are life insurance, disability insurance, and long-term care insurance. Let's just start with life insurance. First and foremost, most people we just talk to have some form of life insurance. I find it very common that a lot of times they don't know exactly what they have. And you can really break that down into two segments. One of those segments can be term life insurance, which we know is more what we consider a renter's policy. It's the most cost-effective way to cover your insurance needs from a pure death benefit standpoint. And then we also move into the world of permanent insurance, which that's where you hear people talk about whole life, or an insurance policy that has a cash value component or a component of savings with it. We use both kinds in our planning, depending on the situation. The family protection can be done a lot of times through pure term insurance, as well as business planning. It can be very effective there. But anytime we get into a situation that a person wants to have a long-term solution for that problem, then we gravitate and move toward a permanent insurance product. And when I talk about permanent insurance, I look at it from two components, because verbiage in this is very important. As you know, most people, when you bring up permanent insurance, the one thing they say to you is going to be, you mean like whole life? It's a pretty common thing. And yes, that's a form of permanent insurance, but there is another form which is called universal life that has sub-segments to it as well, that are all based on the flexibility of those products. So, from a 1,000-foot view, a whole life product is a product that has a lot of guarantees to it, tends to be a little bit more structured, a little more expensive sometimes than what a universal contract can be in. Universal contracts have a lot more flexibility, so we tend to see those used a lot of times in business settings, where you may have a change in your income levels or expense levels from year to year, and you need some flexibility and some adjustment on that. Also, for those people who live in that world like to have the flexibility to make changes if they need to. As a subset of the universal life product, you have what we call a current assumption product, which was the original. It is a pure interest, fixed interest assumption product. You have a variable product, which is tied to the stock markets, which you can have and actually participate in gains and losses within your sub-accounts in your product. You have what we call an index product, which is it's a form of a fixed product, but its underlying investment is also tied to the stock market, but you actually do not participate directly in. You participate in segments tied to. So you have some upward potential with growth, but you have limited downside liabilities to it. And then the last thing, which is really a big product as well that we use a lot, is a guaranteed universal life. And when I talk about permanent insurance, all these different products can be overwhelming, but there are reasons we use each of these products in different situations. And that's the key. There's no one fix-all for any one person or any one client. But everyone is unique, and therefore we try and find the unique solution, to take care of that problem for them. I always stress to people, if you own permanent insurance today, you need to keep a close eye on it. What that means, you need to continually, probably every 2 to 3 years at least, get what we call an in-force illustration run on the product to see how it carries long term. Because these products have functions in them such as crediting rates, mortality costs, administration costs, that can all affect the life of the policy. And a lot of people don't really understand that. They think when I saw that first illustration, I went in and I bought it. My insurance agent laid it down. He says, if you'll pay X amount a year for so many years, this product's going to be there forever. Well, that's not always the case. You know, a lot of when I first came in the business in the early 90s, I remember people bringing in illustrations that were run at a crediting rate or an interest that they earned on that product of 8 and 9 and 10%. And you're shaking your head. You remember those days.
Oh,
you know,
yeah.
Interest rates were high. Interest rates were high. But what we've seen is now interest rates have gone from there and they've come down to where we're lucky to get 2% or 3%.
Yeah.
Well, that directly can affect your product, especially interest-sensitive products like universal life contracts, because you base your premiums on a higher yielding or a higher returning a product that's not come to fruition. Yeah. So when you run those in-force illustrations on those products, you can actually see the health. Is it really going to carry till I'm 100 years old, or is it going to die when I'm 85 or 80 or some other time?
Let me interject here for a second, Brandon, because I mean, my brain is just like, I'm having ideas left and right of things we could talk about. And what I want to do, I think what we'll do is let's hit on these other topics real quickly at the high level.
Okay.
And let's circle back at the end, time allowing, and talk some more about this life insurance area. But I do just want to say this before we go any farther. What you've already shared is the reason why, even though I've been in the business a long time, and I've told you this, my background, I came in with a firm that was fairly heavily insurance oriented, and I left after 9 years, but that experience taught me a whole lot about how complex this part of our business can be. And it's complex in two ways. It's not just, you've just gone through a kind of unfolding at a high level the different kinds of products just in the life insurance category, and they can each have their role, right? But then there's this whole other side of of knowledge of situations that how do these products apply, right? And so for me, I know how important it is for somebody who's giving advice in this area to not only be up to speed on all these product evolutions out there, but also staying top of mind on the different ways that these creative products can actually be used to solve real problems for people. So we can come back and talk some more on the life insurance, but
okay.
I at least want you to have a chance to hit on the disability, long-term care, the business planning, and the estate and legacy planning before we dig a little deeper. Go ahead.
Yeah, but I'll try and be a little quicker. We'll go through this. You know, disability insurance is probably one of the next largest areas we do a lot of work in. What we find, Bob, in the industry is people have either no disability insurance because they don't know what it is, don't understand it, or they may have what we call a group long-term disability program that's offered through their employer of some kind, and then also the individual disability insurance, and that's what we focus on predominantly. Mm-hmm. And it's funny, I always ask people what your most valuable asset is when we talk about insurance or risk management. And they always bring up their home, or they bring up their retirement plan, their 401k, whatever it is. But really, when you step back and think about it, the greatest asset you have is your ability to go to work every day and to insure and protect that. And that's all disability insurance really is, Bob. It's the type of coverage that will come into play if you can't go out of bed because of accident or injury or sickness and go to work to earn a living for your family, then it will pay you a benefit on a monthly basis for a period of time. That's what it is in a nutshell. And you look at different things. People ask, what's the best type of disability policy? I hear it in verbiage: the best disability policy pays the most benefits in the most claim situations. Mm-hmm. And that's where when the biggest question we get is, I have a group long-term care or disability insurance, and you're showing me an individual. Why would I do something different when I've got it at work? And this is where we can get in, and we've spent a whole session on this alone, just like we could anything else here. It really comes down to a couple of things. Definition is very, very important. How do they define your disability? Okay. Secondly, is it portable? Your group LTD portable if you change jobs? Usually it's not where your individual disability is. Does it have guaranteed premiums? Not typically. They go up with age in group programs where an individual policy is a good one. They're going to be locked into a premium. Is it renewable? It's always going to be there. Yes, it is with a good individual policy, but your employer can at any time stop offering a group long-term disability program and you can lose that coverage. So from that 1,000-foot view, those are your two predominant long-term disability type programs that you see. We focus with individual disability. We do a lot of evaluation with group programs, and a lot of times people will end up stacking those. You may still keep some of your group, but you may add two with individual because of what it brings, because of permanency, the guaranteed rates, better definitions, the ability to pay a better benefit in the event something happens. Okay.
So, yeah, and we've seen some people actually qualify for SSDI, Social Security Disability payments. I mean, again, like you said, we can have future episodes where we go into these in detail. But what about this whole area of long-term care? I mean, we see that all the time. People don't understand it. They're not sure what the better products are or solutions. And we always test for that risk exposure in our plans when we do plans for people. We call it stress testing the plan. What can make the plan fail? And a lot of times this is one of those things. So speak to the long-term care for a second.
Yeah, long-term care is just have a pure understanding. And we've all dealt with it in some form or seen it. It is elderly care, or not always. I'm going to step back because that's not really true. We typically see it in elderly situations, but can happen at any time in a lifetime. But it is when you have, the definition basically comes down to if you cannot perform 2 of 6, what we call activities of daily living. Let's step in the definition. Those are bathing, dressing, toileting, eating, transferring, and continence. So if you cannot do 2 of those 6 items, then you can qualify under a long-term disability insurance program that will pay you a benefit that will cover for your care. And that care could be in home care, it could be adult daycare. Most people think about nursing home. Yes, it covers nursing homes. It can be Alzheimer's units. It comes in all form or fashions. The other part of it is if you have a severe cognitive impairment, that will also trigger the event for long-term care. So really when you think about that, we think about our parents aging most of the time. What if they can't care for themselves? Who's going to take care of them at that time? We may both work. We may not be able to do that. Who's going to be there for their benefit? We have to think about that for our own planning needs, because if we're not there, do we want to rely on our children or somebody else to try and take care of us? So that's where long-term care insurance comes into play. It really comes down into 2 forms. One is traditional. It's the old way they used to do it. If you don't use it, you lose it. No guaranteed premiums, rate increases all the time. We see a lot of people who have all those old products that they're having problems with. The new way that we typically see people fund for these, and what we see as a hybrid or an asset-based product, it's built around some sort of life or annuity chassis. That product will pay for a premature death benefit in the event you die prematurely. It will give you a return of premium of some form or fashion if you want to walk away from it. But then if you are there for the long-term care need, it actually covers for that benefit on a multiple basis from an insurance protection standpoint. So really from a 1,000-foot view, those are it. It's to take care of you in the event you can't take care of yourself.
Well, so we got about 10 minutes left, and I don't think we're going to have time to really go narrow and deep on any of these. But again, this is the last time we're going to talk. So it's always amazing to me how much is involved in just one piece of the wealth planning puzzle, this whole area. And so, but I do want to at least have you touch on the business risks and the legacy and estate planning. So let's spend the rest of our time and make sure we get at least some time in on those. Go ahead.
Okay. business planning is very important, and the areas we see businesses utilize our services the most are a lot of times with buy-sell funding programs, with buy-sell agreements. We will also see people use them for non-qualified deferred compensation programs, key man life insurance policy programs. You may need them for debt reduction programs. There's all sorts of reasons why businesses need to look to defer that risk or that cost to an insurance company.
So, so
go
just
ahead.
you and I know those terms, but to the average
Yes.
person, they might not. So for example, buy sell. Let's say you've got an older owner of a business and they've got a younger protege that they would like to sell the business to, but the younger protege doesn't have the financial ability to necessarily buy the business at the older owner's death. And so one of the ways that problem can be addressed is through a buy-sell agreement, which establishes the price of the business up front. And then, how's the money going to be created to execute the purchase? And that's where the insurance would come in.
That is exactly right.
Right. And then on the key man insurance, there could be a business that has like that one person where if I lose that person to a death or a disability or something, I'm really there will be a lot of strain on the business. And so people will use key man insurance to insure that risk, correct?
That is correct.
And
you made a comment a second ago that's really important. I don't think people really understand too, or they don't think about, is you said death or disability.
Right.
I think when most people think about funding a buy-sell agreement or a key person program, they're always thinking life insurance. What if they die?
Right.
Well, when you start really reading buy-sell agreements and looking into that, there are all sorts of triggering events people don't think about. It can be death, it can be disability. I've seen them with divorce. I've seen them with financial security clauses. I've seen all sorts of events that could trigger a partner to be forced to sell prematurely because of an event.
Yeah.
And life and disability are two of the key components. So we do a lot of funding for these types of things with disability as well as life insurance.
Yeah, and again, we could spend a whole session just talking about that. Let's take the last bit of time we've got and talk about legacy and estate planning. Some of the ways that insurance can be an asset in that area.
Yeah, the most common thing that we see is, and it's gotten slimmer in years, but for the transfer of a legacy or an estate with the taxation event on the horizon. So as we know, the rules have changed a little bit, or you and I do, so we'll explain them. Anyone who has an estate that is in today's value about $23 million, north of that a little bit, husband and wife, would face potential estate tax issues upon the second death. What we will do a lot of times is once we go through the planning to reduce the estate for the preparation of the transfer, when we know what the final liability looks like it's going to be, we can create a trust and purchase a life insurance policy in that trust to fund the dollars needed to pay the estate taxes in the future. And that can be done on cents on the dollar. Why not pay 20 cents today to create a dollar you're going to need in the future instead of waiting to try and come up with that dollar in the future? And that's one of the main reasons. We see also very heavily other things that you can utilize it for is estate equalization. I've done that a lot. Mom and dad own a business maybe. That business, they've got a couple of kids that are working it, and maybe a couple of kids who don't. They've got their own lives. But when they pass away, they want to be fair and equitable to everybody, but they don't want to split the business up. Yeah. Well, I've seen them buy life insurance on their lives where they can provide cash to the ones that aren't in the business, leave the business to the two that are, because that's their livelihood. So it's a very good transfer vehicle, equalization vehicle for that.
That is a great point, Brandon. These are the kinds of things that are not always obvious where these tools can be used. But another, along that same lines that we see often in our practice is blended families. And, a lot of times there's physical properties that one spouse wants to keep in the bloodline for their kids, but they want to treat all the kids equally. They don't want to be unfair in terms of value. And so that's another time, a place where we've seen that, there's any number of ways you could envision it being done, but there's so many blended families today. It's very common that that's another tool that sometimes makes sense for legacy planning that way.
Yep. And I think really with all of this, with any of the insurance you're looking at, it really comes down to transferring the risk.
Mm-hmm.
It's since today, transfer a major risk in the future. And we don't know when it's going to happen. Everybody says, what's the best buy? Well, you tell me when you're going to die, become disabled, or need long-term care, I'll tell you how to plan for it.
Mm-hmm.
But if we don't know those things, they're unforeseen, it's a lot more economical to plan for those today than to wait until it happens and try to take care of them in the future. And that's what all of these, I don't care whether it's business or personal, life, disability, long-term care, that's what they all come down to, is the transferring of risk for an unforeseen incident in the future.
Okay, well, so that's a great overview. We actually have a few minutes left. So why don't we do this? Why don't you just give us 3 minutes on the general way that life insurance is unique as far as its taxation? And then if you have time, maybe also explain how disability benefits, sometimes they're taxable, sometimes they're tax-free. Just let's wrap it up just talking about that, because people don't hardly ever understand that part.
Great point, Bob. Yeah, life insurance, just by general rule and by IRS rules, any death benefit that is paid from a life insurance policy is going to be a tax-free event. So if you buy $1 million policy on yourself and you pass away, your wife and kids are going to get $1 million tax-free. Okay. Now, within permanent policies, there's taxation issues you have to watch with the accumulation of the dollars, but you can actually grow your cash values on a tax-deferred basis with the ability to access them in the future on a tax-free component via policy loans. And a lot of people like that. It's a way to kind of save through a tax-efficient means, through those products. Disability insurance is a little bit different. A lot of times you can do those group plans through a cafeteria plan where you can pre-tax them. I always say never do that, because if you use pre-tax dollars to pay for any insurance premium, you're going to create a taxable event on the backside. And so with that said, I always encourage people to always pay your disability premiums with after-tax dollars, whether it's through your business, through your group, or on your individual side, to make sure that full benefit is going to be a tax-free benefit on the back end.
Yeah.
Insurance premiums, life insurance premiums, disability premiums are not deductible. A lot of businesses and people want to deduct those, but they are not. That's what creates that tax-free benefit on the back end, just like we talked about with the disability.
And then I guess just to kind of round it out and wrap up, technically speaking, on the long-term care, a lot of times folks will ask us when we're talking about that, are the benefits that they get from that, if they're under a claim, are those taxable, or kind of just anything you want to say about the taxation on the LTC side?
They typically are not. Basically, what they have stated is if it is a qualified long-term care claim or benefit, which encompasses most everything that you've got, then the benefit you receive from those policies are going to be non-taxable to you. So it's the same with other, but again, you're typically paying those benefits with after-tax dollars. There's a couple of ways, Bob. The one way, I'll give you just a quick example that, let's hypothetically say you have a life insurance policy or an annuity that's out there that has a big gain in it. You can actually effectively 1035 a lot of times those policies into another long-term care product called a tax-free exchange. And the gains that are in those can actually be utilized for long-term care, for qualified long-term care expenditures on a tax-free basis. So that's one of the very few loopholes you can kind of find where you may have a taxable event if you surrendered or took that money out, that you can actually switch it to a situation and get a tax advantage out of it, not have to pay tax on those benefits.
That's fantastic. I love talking shop with people who know their stuff, Brandon. And again, just thank you for your time today. We're up against our time, and we always want to keep these to 30 minutes.
Sure.
So we're going to wrap it up there. But I'll tell you what, if people, when you work with a wealth management firm and they're going through the process of doing a game plan for you, there's so much that happens behind the scenes that people don't ever see. And this part of what we're realizing with these discussions we're having with people in our network like you is it kind of brings some of that to surface. You know, we've hit on a lot of different things today, and obviously no one person all of these things are going to apply to, but any of them could apply to any given person. And so you have to go through and always look at the custom situation you're dealing with. Who are the people you're dealing with? What are the unique opportunities and problems they've got? What do they have to work with? It's what I've always loved about this business. It always feels to me like a giant jigsaw puzzle. And you know, the knowledge in this area is really important, both on the product side, but also on, you know, the kind of pitfalls. You just shared a couple of gems that I hope people caught it. The little bit about the disability premiums not being paid with cafeteria plan dollars pre-tax. Everybody would instinctively say, "Oh yeah, I don't want to pay tax, so I'm going to put in pre-tax dollars." But they don't know what they don't know, right? So once again, a great example of having knowledgeable advisors helping you and guiding you. So Brandon, thanks. And next week, we're going to have another one of our strategic partners on talking about trust services. I know you know Sarah Dewey in our trust department up in Omaha. And Sarah's going to be talking next week with us about the area of trust and why they matter, how they can be used. And so we're looking forward to that. If you have a question about something unique to your situation, all you got to do is email somebody here on the Wise Counsel team. But with that, Brandon, you got any final words of wisdom for us?
Nope, just be safe. Be safe.
Okay, well, you enjoy windy Amarillo up there, and thanks again for your time. Everybody have a great week. Talk to you next time. Bye-bye.
Thank you.